So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to talk about, should you look at individual stock IV or the VIX? So the simple answer to this, I believe, is you should be looking at both. The VIX in and of itself, I don't think is the only thing you should be looking at, because remember, the VIX is measuring implied volatility on the S&P 500. So it's basically just a way to chart or to track volatility on the S&P. Now we could obviously track individual volatility on every stock and ETF out there. So it's not that hard to do. So every individual stock and ETF could have its own VIX-like ticker symbol if we had exchanges that wanted to trade these and products that were related around them. So the VIX in and of itself, I don't think is the only thing you should be looking at. And case in point, to use kind of some concrete examples and numbers right now, the VIX right now is trading in the low teens, and the S&P 500 is rallying higher. So it's up on the day at the time I'm recording this. And there's a lot of other individual stocks right now that have much higher implied volatility than the VIX, and in many cases, much higher implied volatility than even some of the other peer groups in ETFs that we track. So things like EWW, EWZ, XOP, XLE, SMH, etc., all have high implied volatility right now on an individual basis. So if we just looked at the VIX and we didn't look at individual stock IV, we might be missing an opportunity to trade these kind of higher IV, low-hanging fruit type opportunities as an option seller. So that's why I think actually both are important. I mean, look, you can use the VIX as a gauge or a general broad market kind of brushstroke of where implied volatility is, but you definitely want to dig into some of these individual stock IVs because sometimes you can find really good deals there, really good IV deals, if you will. So I think, again, the answer is both. I wouldn't look at just the VIX. I wouldn't look at just individual stocks, but you should be monitoring both. So hopefully that helps out. As always, if you guys have any questions, let us know. Just head on over to optionalpha.com/ask and get your question submitted, and we'll get it added up to the queue here on the Daily Call. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from optionalpha.com.